Hey traders, welcome back to another episode of HedgeProf. In today's video, I'm going to show you a very aggressive but structured hedging strategy designed for traders who want controlled recovery, fast execution, and strict trade management. Now, listen carefully. This strategy is not based on prediction. We are not trying to guess where the market will go. Instead, we are using hedging, partial profit taking, controlled recovery entries, and engulfing candle confirmations. This system works best during volatility, especially during the New York session. But before we enter the strategy itself, let me first explain the entry signal properly so everybody watching this video can understand exactly what to look for. So let's start with, what is a bullish engulfing candle? A bullish engulfing candle is a reversal pattern that usually appears after price has been moving downward. Here's how it forms. The first candle is bearish. Then the second candle opens lower or around the same area. But buyers suddenly take control and push price strongly upward. The body of the second candle completely covers or engulfs the body of the previous bearish candle. That is why it is called a bullish engulfing candle. This tells us that buyers are becoming stronger than sellers, and price may begin pushing upward. Now let's talk about the bearish version. What is a bearish engulfing candle? A bearish engulfing candle is the opposite. It usually appears after price has been moving upward. The first candle is bullish. Then the second candle suddenly becomes strongly bearish and completely covers the body of the previous bullish candle. This tells us that sellers have stepped into the market aggressively and price may begin moving downward. So for this strategy, bullish engulfing equals possible buy momentum. Bearish engulfing equals possible sell momentum. Very simple. Now let's get into the full strategy. We're going to be performing this strategy on the 5 minutes time frame on Euro to US dollar. Trading session from 2 p.m. New York session. Entry signal. Any clean bullish or bearish engulfing candle. Now note, this strategy is totally different from the previous strategy we discussed in the last video. So stay till the end of this video so you can understand the full system correctly. Now here's the core logic of this system. At the same price level, open a buy position and open a sell position at the exact same time. Starting lot size, 0.01. Risk to reward ratio, 1 to 2. Stop loss, 5 pips. Take profit, 10 pips. Now if you're using 0.01 lot size, 5 pip SL equals around 50-cent loss. 10 pip TP equals around $1 profit. Very important. Once either trade moves 5 pips in a profit, close 50% of that position immediately. Then leave the remaining half running toward the full take profit. This is where the protection mechanism comes in. Because if price reverses after you already secured half profit and comes back to your stop loss, you basically close around break even on that trade. That means you protected capital, reduced emotional pressure, and still gave the trade room to continue running. This is the entire philosophy behind this strategy. We're not trying to catch huge moves. We're trying to survive volatility while extracting control profits. Now let me give you practical examples. Example 1, by scenario. Let's say Euros forms a bullish engulfing candle on the 5-minute time frame during New York session. Current price, 1.1000. You immediately open. Buy 0.01. Sell 0.01. At the same price. Your buy trade now starts moving upward. The buy reaches plus 5 pips profit. At this point, you close 50% of the buy position. You secure partial profit. Now, suppose price suddenly reverses downward and hits your original stop loss. Because you already closed half the position at plus 5 pips, the remaining half closing at loss balances things out. Result, you roughly close the buy trade around break even instead of taking full loss. Meanwhile, your sell hedge may begin gaining profit as price drops. This is why hedging gives flexibility. Example 2, sell scenario. Now let's say GPUST forms a bearish engulfing candle. Current price, 1.2500. You open. Buy 0.01. Sell 0.01. This time price drops aggressively. The sell trade reaches plus 5 pips profit. Immediately, close 50% of the sell trade. Leave the remaining half running. Now imagine price suddenly reverses upward. The remaining half of the sell trade may eventually hit stop loss. But because you already secured profit from the first half, you avoid taking a full losing trade. And if the market keeps reversing upward strongly, your buy hedge may now start generating profit. Very important. This system is designed around flexibility and recovery.